Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Headline inflation came in lower than expected during the month of January, continuing the trend down towards the Reserve Bank's target range, but it isn't there yet. The monthly indicator can be a little volatile, so it's worth looking at the factors that go into it and what it all means for interest rates, of course. Mousina is AMP's Deputy Chief Economist. Diana, welcome back to Fear and Greed.
Thank you, Sean.
The numbers out yesterday. What did you think of them, the monthly inflation for January?
Well, it was good to see that further moderation in inflation continued into January. There was always this risk that we would get a spike up in inflation in January because a lot of other countries overseas, like the US, Japan, all had this bit of an increase in inflation over that month. Some global factors at play, more supply side issues coming through with transport costs around the world up a bit and commodity prices as well, given what's going on in the Red Sea. So while it's good to see that inflation is running at around 3.4% in headline terms. I think the difficulty with interpreting the monthly data, because it is not a full set of inflation figures, it's not as broad-based as the quarterly data. It doesn't survey services in the month of January. I think it's difficult to get too excited that inflation is going to continue to decline significantly. There is still the risk that you get a bit of a bounce back up in price growth.
Okay, so just explain what's happening with goods inflation and why that's falling so fast, and services inflation, which isn't falling as fast, and why is that?
Well, goods inflation was really driven by what happened during the pandemic, a lot of the supply side disruptions and the increase in consumer spending that went alongside with it increased the prices of goods. Now, goods usually lead what happens in the services sector because services inflation is mostly actually driven by wages growth. And wages tends to lag whatever happens in goods prices and generally just headline consumer prices because consumers normally like to be compensated for around whatever's happening to inflation. So that's why services inflation is still lagging what's happening in the goods sector. Goods price inflation has come right down around the world, including in Australia, but services inflation is still elevated. And it's really that component that the Reserve Bank is worried about. It's not just services that the Reserve Bank is worried about. It's really more about, I think, more around that essential category of spending. So things like utilities, housing, which is mostly rents and new dwelling construction costs, insurance and finance, healthcare costs, other personal services types of costs, and utilities, of course, as well. And the types of things that you can't really cut back on spending, those are the ones that have seen a lot of high inflation over the past 12 months. But I think that they will take the lead from the goods sector and that inflation will slow. It's just a matter of if it slows enough that the Reserve Bank is comfortable to start cutting interest rates or even to start considering cutting interest rates.
Okay, so the next meeting, which is still a few weeks away, you don't expect a rate cut, but it's about the language.
That's right. I mean, the next step for the Reserve Bank would be to remove their hiking bias. I'd call it a soft hiking bias, and they're still considering the possibility of whether they need to raise rates again. They're still debating at the board meeting whether they should be holding or hiking rates. So the next step would logically be for the RBA to remove that hiking bias like the Fed or the ECB have done. But I think that looks like a bit of a stretch for the March meeting. The RBA, in their commentary, we had a lot of commentary from Michelle Bullock in the past month. They still sound like they don't want to lead inflation expectations to increase. They don't want inflation to start increasing again. I think they're going to tread carefully, and I just don't see them getting rid of that hiking bias unless we get something going completely wrong, like a negative GDP print next week or some very poor retail data. I think something would really need to go astray to get that hiking bias out of the way.
Before we leave the detail on this, oil prices, why do we care so much about oil prices, petrol prices in this data?
Well, petrol prices are actually a good gauge to consumer inflation expectations. Consumers actually have a really bad track record around predicting inflation. They normally just tend to use whatever is going on at the moment. They always overestimate inflation as well. And inflation expectations moves in line with petrol prices. It's very visual. Consumers can see how the price of petrol changes every day or every week whenever they're filling up their car, and they do use it as a gauge, which is why people care so much about it. And it can lead to not significant but moderate contributions or detractions from the inflation data. So that's why people tend to look at it.
Stay with me, Diana. We'll be back in a minute. I'm speaking to AMP Deputy Chief Economist, Mousina. When is the next rate move then, Mousina? When is it and which way is it going to be?
Well, our official view is that it will be in June, that we'll see a rate cut by June, which is not really too far away. It's another 3 meetings because there is no board meeting in April. I mean, I think that the risk here is that the RBA will need to cut interest rates in the second half of the year. I suppose I'm worried that the Reserve Bank will be too concerned that inflation's going to be sticky and above their target band for longer than they'd like, which is why they may not move to cut interest rates. I think as soon as the economy needs that support, we've already seen the unemployment rate increase by 0.7 percentage points to 4.1%. I think we're going to get some more weakness in the labour market figures. And I think that the consumer really will need that support this year as the labour market deteriorates. Earnings season in Australia wasn't particularly strong, and some of the discretionary retailers are suggesting that there's some more downside to come. So I think that we'll see further weakness in the economy that will justify the need for rate cuts. But yes, it may not come in June; it may come in the second half of the year.
As a house, AMP has generally been slightly less optimistic about the trajectory of the economy. Let's say over the last 6 months, you've sort of been calling for rate cuts perhaps before others. Is that about the consumer?
Ultimately, yes. That's really what our view hinges on. We were of the view that the Reserve Bank wouldn't hike rates as much as they did, and that rested on the view that the consumer would have felt more pressure from interest rate hikes. So I have been very surprised by the resilience of consumers. I think it came down to the fact that the labour market held up so well. So even though consumers had these headwinds of higher interest rates, high inflation, an increasing fiscal burden from bracket creep and paying more tax, they were able to offset that by high savings and ultimately being employed. The key differences for 2024, though, is that the labour market's weakened and further weakness is likely, and that the consumers, where you're worried about them having those savings to draw down on, have probably used up all those additional savings. So in my eyes, 2024 is going to be a tougher year for the consumer than last year, even though cost of living issues were kind of everywhere. I mean, that could be offset by the tax cuts that are coming from the 1st of July, potentially more tax relief or potentially more cost of living relief from the government in May. But I think it would be a mistake by the government to start giving people more cash in the May federal budget if we are still in this environment of elevated inflation.
Is this a soft landing we're heading towards, Diana?
Well, we could be in a soft landing right now. I mean, maybe the central banks have engineered everything perfectly that this is the worst that it's going to get. I mean, we think that next week's GDP figures will show that growth was at about 1.5%, actually a bit lower than that in the December quarter of last year. That's pretty low for Australia. It's a per capita recession. And it's not a particularly strong environment. But if it doesn't get any worse from here and we actually get those rate cuts around the middle of the year and the economy starts to recover, maybe this is the worst of it. But, as an economist, you have to think about the probabilities. And history tells you that the probability of a central bank mistake, a downturn or a recession is still high. So I'd say that the risk of a recession in Australia is still at about 40% this year.
I'm not allowed to talk to an economist without asking about house prices. And I do apologise. I'm sure you're sick of people asking about house prices, but what do you reckon will happen in 2024?
Housing market has surprised us considerably. I mean, I think it really did for everyone, but the rate of the population growth, I think, has just been the key driver of that. And the fact that we're just not building enough homes. And the construction work done data yesterday showed that residential construction went backwards massively again in the December quarter. So it looks like we're in for another year of a positive home price growth, but I don't think it will be as high as 2023. We think low single digits, maybe between 2 to 5%, which is obviously still positive, but not as high as we were used to last year. We've probably seen the levels of peak population growth, which should help some of those housing supply issues. At the same time, we're just not building enough homes, and there's still a lot of pent-up demand for new housing, which will keep prices elevated. But at the same time, people have taken a 30% hit to their capacity to borrow. If you go to the bank today, you can take out a loan that's about 30% less than you could have before the RBA started hiking rates. So that will have to hit people as well when they're going and getting that mortgage.
Diana, thank you for talking to Fear and Greed.
Thank you. It's been a pleasure.
That was AMP Deputy Chief Economist Mousina. This is the Fear and Greed business interview. Remember, this is general information only and should always seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.